Welcome back, you legends. I'm Dr. Kala. Let's get right into this video. It's 3:30 a.m. in the morning as I'm recording this. I'm at UTC +3. There was a lot of construction going on downstairs in my building, so I simply could not get the video out earlier today. I just could not record it. It was too noisy, so I took a nap, woke up at 3 a.m., got the charts ready for you guys, and just to record this video. It's going to be a very quick update because I gotta get back to sleep, guys, but this is going to be a good one. So let's get right into it. This is the weekly stock market map. As you can clearly see, tech and especially semiconductors, the fastest growing part of the tech sector, got hit the hardest last week. I'm going to explain exactly how to see things like this happening before they do, how to spot these weaknesses in the market before they do, so you can exit your positions and potentially even put on short positions before you see the selling come in. There's a very beautiful chart that we use to spot weakness in the semiconductors that I'm going to discuss in a minute. But here it is. We had healthcare leading and energy and defensive financials like Berkshire leading the market. So it's a very defensive rotation last week. Obvious defensive rotation. Even in the communication services, we saw the growth sector, Google and Meta down, and the old economy value sector, Comcast, T-Mobile, Verizon, etc. These leading the market. So let's take a look at the different sectors. Here it is, weekly relative performance to the S&P 500. Energy led at 2.6% in the green, followed by healthcare. I do think that healthcare will be the leading sector in the rest of August, September, and into mid-October, and I'll explain why later. Utilities, defensives, and communication services somewhere in the middle. And then we had tech and cyclicals lagging. So very obvious defensive rotation out of these high risk, high growth sectors like cyclicals and technology into defensive old economy style sectors like healthcare, utilities, and energy. Energy obviously seeing a breakout due to the rise in yields, as well as that hot PPI report that we got last Friday. On the day, we had a mix of weak growth, weak NASDAQ, strong value, strong Dow Jones, S&P basically flat, and the Russell 2000 basically flat. The NASDAQ dragged down by those declines in the semiconductors led by NVIDIA. So let's jump straight into the S&P 500 daily chart. This is the daily chart. And we came very close to filling the gap at 442.9. We did not fill it. I saw some other technical analysts saying that we filled the gap. On the SPY ETF, we definitely did not fill the gap yet. We have the 50-day moving average coming up, and this will act as support as well as the gap. So we have two converging market conditions that will support the market at the 50-day and at the gap level at 442.9 to fill the gap intraday. It's not filled until we go back to fill the gap at the close of July the 11th. So that's 442.5, getting very close to that gap fill. That will likely act as support, as well as the 50-day, the rising 50-day moving average. And we do have a bunch of bullish divergences still on the 1-hour chart. This is the weekly chart for the S&P 500 index, the SPX. This down here, guys, is the bullish percent index. We're now at below 38. Usually, guys, below 38 in an uptrend, we get support. We get a buy the dip activity, right? In an uptrend, usually below 38, we get a bottom and a rally, a bottom and a rally. When the market is beginning to weaken, right, when we're in a downtrend, a weekly downtrend, usually when we get below 38, we get even weaker. Below 38, more selling. Below 38, more selling. Below 38, more selling, and more selling, and more selling. The only exception to this was the May bottom, that volatility contraction bottom that I discussed at length before we got this insane rally in the market. That was the only exception, and that told us that the market was in an intermediate uptrend on the weekly chart. Right now, guys, this is going to be very telling. If we get extensive weakness, more selling in the coming weeks, it will confirm that the medium uptrend is over and we're back in a medium term downtrend. What does that exactly mean? Well, if we're back in a downtrend, guys, it means that we'll start to make new lows relative to the uptrend. So these lows will likely get taken out if we begin a new downtrend. However, if the uptrend continues, we should start to see some buying in the next couple of weeks. And these lows that we've made so far around the gap fill area at 442, these should hold. If they don't, we'll know that a medium term a downtrend has now begun, and all of these lows will inevitably get taken out. Now, below that, guys, is the market cycles. I started to do a lot of cycle analysis in the middle of last year because I noticed a very clear cyclical pattern. If you notice here, guys, we got a bottom at the bottom of the cycle. This is a long-term cycle. Let's take a look. Here it is. 455 days. So this is a year and a half cycle, roughly a 15 to 16 month cycle. And we got a bottom at the end of every one of these. The only exception was June 2021, and that's because we had a very extensive, very strong uptrend in the market. So we got a bit of a pullback, and that was it. This was the pullback here in May of 2021 in March. Then we have what is called a left-hand translation in the cycle that began in mid-2021 and ended in September to October of 2022. And that was the market topped in the middle of the cycle and began to make new lows. And what do I mean by that? This low was taken out in the right half of the cycle. If we divide the cycle to two halves, a right half and a left half, in an uptrend, you want to see the right half, a pullback in the right half. You want to see higher lows, not lower lows. And the perfect example of that would be the second half, the 2020 to 2021 cycle. You notice, guys, the second half of the cycle, we had higher lows, consecutive higher lows. Whereas in the 2021 to 2022 cycle, we had already broken critical lows early on in the middle of the cycle. We went on to make even lower lows. So what does this current cycle look like? Again, we have another bullish looking cycle. We had the bottom in October. The market continued to make higher lows throughout the cycle. The top came in the second half of the cycle. And usually that means that this cycle is still bullish. In a bearish cycle, you would get a bottom in the, a top in the middle of the cycle or earlier in the cycle. So this was a bearish cycle. We had a top in the middle of a cycle. Then we made a lower low. In the current cycle, guys, it is still bullish. We're still making higher lows and higher highs, even though we're starting to see some significant weakness. And quite frankly, it's overdue. We had this very extensive multi-month rally in the summer. So we are overdue for a significant correction, a significant pullback. We're beginning to see some of that happening in the last couple of weeks. But as we get into the seasonality picture, guys, seasonality tends to see some bounces in the middle of August, right? If you notice, guys, after the 8th of August, usually the market tends to see a nice bounce all the way into the 12th or the 13th of August. So we do expect potentially either a gap fill and a counter trend rally back up, potentially to fill this gap at 456, or come slightly short of that and stop at the bottom of the gap at 453. Let's take a look at the hourly chart for more granular analysis. Here it is, guys. My initial target is a gap fill at 456 in a counter trend move. That could fail much earlier. We could see that rally fail at 453 at the bottom of the gap. This is the gap. This entire space is a gap. So we could either see failure at the bottom of a gap, which would be a lot more bearish than if we filled the entire gap up here. Either way, we're still seeing a positive divergence, a bullish divergence on both the stochastic and the PPO down below. Both are momentum indicators. Momentum continues to show a positive divergence, even though the market has been making lower lows. Momentum has been making higher lows, suggesting that these lows, every one of them has been bought. We still have this gap here at 442.5. Again, we could either see something that looks like this, a gap fill, double bottom, continuation of the positive divergence, then a break of the descending wedge. A descending wedge is a bottoming structure. It is a bullish structure. We're still forming a descending wedge pattern. And so a double bottom, then a rally towards either the top of the range, this range in the black box, or the bottom of this gap again at 453. And on the very high end, we could go back to 456. Again, if we stop at the bottom of the gap, that will be a lot more bearish. If we stop at the top of the gap, if we fill the gap, that'll be more in line with a run-of-the-mill counter trend move. So how would we trade something like this? Well, we'd have to see first a break of the resistance line of this descending wedge. We had an initial break back here in this short squeeze that we did trade to the upside. I did open a position at the close of the day, and I did close the majority of my position at the top of this candle. If you believe it or not, we closed at the top of that candle, and then I set a stop loss, and that stop loss got triggered, so I ended up closing my position at a 60% profit. It was at a 150% profit at the top of the candle. I closed half there. Then I ended up closing half of the position after we got that rejection. So I ended up with an overall 60% profit on that trade. Now we're waiting for a break. So the way to trade this, guys, we'd have to see a break of this resistance line, then a back test, and an entry would be on the back test. A perfect entry would be on the back test. So we would be looking for something that potentially could look like this: a break, then a back test, and a rally. The entry would be the back test. Another way this could play out is we could go back down, fill the gap, and an entry would be at the gap. Then we get a back test. You put a stop loss on the pullback of the back test. The stop loss would be put in here. That would be the stop loss, and potentially you would add to that position here. Then you'd ride this position to the top of the range all the way to these rejections. In terms of a bearish trade, it's really difficult to trade. It's really difficult to initiate a bearish position now after the market has already seen extensive selling. So for a bearish put position in terms of options, you would have to wait for a counter trend move and then either initiate at the top of the box or on a rejection. You would wait for the turn first, and then you'd enter at the rejection and the downtrend move and the continuation of the downtrend move. So that's how I would personally trade something like this. Speaking of trades, guys, this is the last day of the 70% a one-off promotion that I'm running in celebration of the 1-year anniversary of Money Time Machine. This is the deepest discount I've ever done on the Living Legend membership. It's 70% off for the annual membership. You have to click pay annually to be eligible for this discount. If you sign up without clicking pay annually, unfortunately, the payment will be declined automatically. So if you want to do annually, click pay annually, then join. If you want to do the monthly option instead, just go for the resurrected monthly option. Both of these, guys, the resurrected monthly and annual memberships, are special status memberships in celebration of the 1-year anniversary of Money Time Machine. They are equivalent to the $120 Living Legend membership. So please don't sign up for the Living Legend membership. Sign up for either one of these to take advantage of this discount. I've never done a discount this deep. To take advantage of it, if you've been thinking about joining the community, this is the best time to do it. It's where I share my trade ideas, my daily analysis, all of my trades and investments, and my market notes pretty much every day. Thank you guys for your support. Obviously, you don't need to sign up for any of this. You can simply just watch the videos, And I really appreciate you liking the videos, commenting on the videos, which is totally for free. If you want to do that, I thank you. If you want to be part of the community to get access to my trades and my setups, this is the only way to do it. Okay, so I want to talk about volatility because volatility is telling us that we are due for a counter trend move, right? Volatility topped on August the 8th. Let me add the S&P 500 on here so you guys can see what happened. Volatility did, in fact, here it is. It topped on August the 8th. So in terms of volatility, volatility is indicating that we are now in a bottom formation process. We do have a bullish divergence between volatility and the S&P because the S&P 500 continues to make a lower lows as volatility continues to decline. That's exactly what we want to see in a bottom formation process. You want to see volatility coming back down, and you want to see some residual weakness in the S&P, and that usually happens to be the best time to enter a position to capture a counter trend move. Now, this looks almost identical, guys. This structure looks almost identical to the bottom that formed back in March. Here it is, a triple top on the VIX and a bottom established on the S&P 500. We have pretty much an identical look here, triple top on the VIX, and the S&P 500 is now trying to find a bottom. The VIX did continue to roll over on Friday despite some of that selling and that weakness in the market. Look at this. Triple top formation, rejected inside my red box of resistance. Then we rejected in the lower half of this box in this range once, twice. The third time was even lower. So we're seeing volatility escape the market. Volatility is now declining, and that's in line again with that seasonality, guys. Volatility tends to decline when the market is ready to move up, and that's what we're seeing now. In the middle of August, we tend to see that counter trend move to the upside. So we're due for a counter move to the upside now in the middle of August. And the VIX definitely suggests that we are now due for a counter trend move to the upside as long as we continue to make lower highs on the VIX and as long as we continue to trade below this 200 period moving average on the 1 hour chart. Again, the daily chart has this rollover look. We have made a higher high versus this high back in July, which is suggestive of a prolonged downtrend forming here, especially if we fill this gap on the VIX and then we start to move back up, because that would be the first higher low that the VIX has made in several months, and that would establish a new uptrend in volatility, and that would mean more downside in the market in September and October, which is very likely. So that's what I'm expecting now. I'm expecting this gap fill with the VIX coming in below 14 or at 14, then with the market rallying, forming a counter trend rally, and then the VIX finding a bottom and moving back to the upside. It's almost impossible, guys, to short a market with the VIX moving down. It's almost impossible to make any profit doing that, because if you buy puts, even if the market continues to decline, as long as the VIX is declining, you will lose premium on those puts. So it's impossible to short a market with volatility declining. And that's why really a lot of bears will now capitulate in the short term, very likely capitulating in the short term. And they have to let this counter trend play out so they can get a better entry and then ride the move back down as volatility shoots back to the upside. That's really the best way to trade this. You can't continue to hold a put position as volatility is declining, even if the market continues to show weakness. You will simply lose that premium on those puts. Again, it's one of those market dynamics that allows for those really choppy trades in a downtrend, a lot of big moves up and moves down, a lot of things that look like this, right? Volatility plays a huge role in that. And next week we have option expiration, which tends to bring out even more volatility. So if we get, again, a gap fill, something that looks like this, and a rally, and you see volatility getting crushed, this will likely prove to be an excellent shorting opportunity to ride the market back down as the VIX shoots back up. Let's take a look at the triple Qs. What does the NASDAQ look like? Continues to form this bullish falling wedge. We have filled the gap on the NASDAQ. We're now just waiting for the S&P 500 to do that. Probably just days away from filling that gap, or simply seeing a counter trend move and then coming back down to fill the gap. Either option is possible. In terms of the NASDAQ, guys, continuation of this falling wedge pattern. It is a bullish falling wedge pattern. PPO continues to shoot down, a very weak looking momentum here, but we did print an inverse, a hammer candle on Friday. Usually these candles, guys, with long wicks and long tails and a small body are indicative of indecision. Indecision candles, guys, are typical of trend exhaustion. When you see them at the top of a trend, it usually means a reversal to the downside. When you see them at the bottom of a trend, usually indicates a reversal to the upside. Again, see them at the bottom, reversal to the upside. See them at the top, reversal to the downside. You can see a lot of these, guys. Here's another one at the bottom, reversal to the upside. At the top, reversal to the downside. At the bottom, reversal to the upside. Let's take a closer look. A lot of these here back in late February. At the bottom of a trend, we ended up with a counter trend move to the upside. Again, you can see them here at the bottom of the that October low, that major low, and we had that rally. Then when you saw them at the top, here it is, that tombstone candle at the top, we got a reversal to the downside. Let's take a closer look on the 1 hour chart. What do we have here? Really continuation of the lower lows and the lower highs on the NASDAQ. So even for trying to trade that counter trend rally, the NASDAQ will likely see the biggest percentage gains, but that will likely last only a day or two, and that's it. And the Dow Jones will likely continue to lead the market in September and in October. If you notice, the Dow Jones is just flagging. It continues to flag, likely going to continue to flag as we hit the prior swing highs here, right? As we hit these prior swing highs, and then we'll see another breakout potentially in the Dow Jones and continued weakness in the NASDAQ. So a key chart to look at, guys, is the NASDAQ relative to the S&P 500. So let me pull that chart. Here it is. Up top is the NASDAQ relative to the S&P. We were in a solid uptrend in this channel. We broke that channel as the market was topping in late July. Usually what happens after we break a channel like this, we double the distance. That means we connect the middle of the channel to the bottoms. That usually gives us a very good idea of how more selling we're going to see. So let's take a look. Probably another 4% down on the NASDAQ relative to the S&P 500. If we apply this concept of doubling the distance, that's usually how it has played out in the past in my experience. And that's how I expect it to continue to play out. In terms of the PPO, still looking pretty bearish here. We're now closing below the zero line for the first time in the entirety of 2023. What that means is that it's over for the NASDAQ. It's over for tech. For the vast majority of the second half of the year, tech will very likely continue to weaken. And I want to talk about some of these key setups in tech. Things like NVIDIA. NVIDIA broke this key support line back here in early August. Since breaking that support line here on August the 8th, we had a waterfall style sell-off in NVIDIA. Remember, NVIDIA guided up significant revenue growth and profit growth back here at their last earnings report. If they miss, I expect NVIDIA to fall all the way back down to its pre-earnings price level at 306. That's right, 306. So that's from the highs all the way back down here. That's 36% of the downside, at least, if they miss on their next earnings report. We've seen something like this happen before in 2018. Here it is. It was exceptionally ugly. It was really bad. This is it, guys. NVIDIA was forming its final highs. We had this double top with a bearish divergence on the daily chart. And NVIDIA ended up topping in October. Then we had this really insane crash. It was a crash. There's no way, there's no other way to describe it. down, let's take a look, 57%. And this was a bull market. This was a full-blown bull market, okay? So we had a 57% crash in a bull market. It wasn't even a bear market. This was the China trade war that was going on, and Nvidia did not recover those highs until several years later. It took Nvidia 500 days just to recover the highs, and that was a bull market. That wasn't even a bear market. And Nvidia is insanely overvalued. I mean, if we take a look at Nvidia, let's pull Nvidia up on FinViz. Here it is. Forward PE at 35.8. That's assuming Nvidia hits that earnings target this quarter and for the next 4 quarters. If it continues to grow for 4 consecutive quarters, that's what we expect. If it misses, we're talking about a 200 plus PE. 200 plus PE. So Nvidia could easily lose half of its value in a span of a few months in a bull market. Okay, in a bull market, not even a bear market. We're not even talking about a bear market. In the 2008 and in the 2002 bear markets, Nvidia lost 80% of its value. So in a bear market, we're talking about 80% down. In a bull market, 50%. Let's assume best case scenario, this is a bull market. Let's just say it's a bull market. Let's ignore all of the fundamental economic events and conditions, and let's just say it's a bull market. We're talking about a 50% decline. And during the side, if we just take a look at the support lines, usually, guys, when one support line breaks, we move back down to the next one, and the next one is at 290. 290 by September, so 300 by October is very possible, and in fact, quite likely. And quite honestly, Nvidia is long overdue. This is a full-blown AI bubble, and the bubble is now beginning to burst. If I take a look at Microsoft, Microsoft looks quite bad. It's very bad, in fact. And a lot of you asked me in the trading community a couple of months ago about where I expect Microsoft to go, and I said I don't see any support, zero support until 295 to this prior swing high, to these swing highs. So no support at all for Microsoft. All the rallies in Microsoft will very likely be sold, will be used to sell into. Now, the 20-day is about to cross below the 50-day. The 50-day is this green moving average. The 20-day is this dark red moving average. When this crosses down, I expect a counter trend move to the 20-day, rejection, and continued selling. This would be the perfect short entry to short Microsoft all the way down to 300 and potentially even lower to 275 to fill this gap, the pre-earnings gap back in April. Now, if you've been charting for any length of time, you will immediately call this out for a double top. And it is a double top, very obvious double top. If we pull out the weekly chart, it's a double top, very obvious. We had a cross down on the PPO the last couple of weeks. Huge tombstone candle. A perfect top formation. This is a gorgeous tombstone candle at the top. Very clear, very obvious. And so this was a clean looking chart. And if I pull out the 1 month chart, so the monthly chart, look at this. This is a disgusting bearish. Disgusting. I've never seen a bearish divergence this bad. Look at this. Double top, higher high on the second top, significantly lower high on the PPO. Really ugly looking bearish divergence. And we've not seen anything like this in years. Look at this. Insane bull market since 2013 all the way to 2021. Microsoft never closed below the 20-month moving average until the 2022 bear market, the bear market of last year, and we're now forming a double top. So this could get really ugly. If we just pull back to the 50-month moving average, we're talking about a 30% decline from the top. If we pull back to the 200-month moving average, that would be cataclysmic. In the 2008 bear market, that's what we had. We had a sell-off all the way back down to the 200-month moving average. In the 2000 bear market, because it was an insane bubble, so it's very comparable to the bubble that we've seen in tech the last 10 years. This was a massive rally. We ended up with a sell-off below the 50-month moving average, a 60% decline from the top. And so that would mean we retrace back to the 2020 lows, okay? The 2020 lows, the pre-pandemic, excuse me, the pandemic lows. Here it is, 60% decline. This would be in line with the 2000 to 2003 bear market. This will obviously take months and months and months to develop. We're still not in a recession. We're on the doorsteps of a recession. That's likely now, starting at the end of the summer. Ed Hyman, the top-rated economist for 20 years in a row, is forecasting a recession at the end of the summer. So we're now beginning potentially to see signs of major demand destruction and the recession finally hitting at the end of the summer. Big crashes usually happen after the yield curve uninverts, exits inversion, and begins to steepen. So let's take a look at the yield curve. Here it is, guys. Up top is the yield curve, the 210 yield curve. And usually bad things happen when the yield curve exits inversion. Let me show you exactly what I'm talking about. So when we dip below this horizontal red line, that's when we enter inversion, and we exit inversion when the yield curve moves back up above it. And we do have this double bottom with a positive divergence on the yield curve. Look at this, the PPO is now turning back up to the upside. And we're likely now months away from this yield curve exiting inversion. And what does that mean? Okay, let me show you exactly what that means. This was 2006. That's when the yield curve entered inversion. And this is the S&P 500, guys, down below. Here's what happened. This is the yield curve inverting in 2006. This is 2006 when the yield curve exited inversion in late 2007. That's when the stock market put in its final highs and we had that crash. Exact same look here, guys. In 2000, we had the yield curve invert in early 2000. It exited inversion in early 2001. This is exactly when the inversion ended. And that's when we had that massive crash, 2-year crash in the market. This is by far the best tool, hands down, to time a market crash, a major recession-led market crash. This is only effective for recession-led crashes. So you want to see the yield curve invert, move down below the 1% line. This is the 10-year divided by the 2-year. You want to see the yield curve invert, dip below the 1% line, then recover and come back up. When this cross happens, that's usually when the market puts in its final high for the cycle, and that's when a lot of selling begins. That's when the real crash begins. Now, I want to talk about smart money because it's essential in the medium term. Smart money continues to form a bullish divergence, making a higher low here versus the low on August the 3rd, while the S&P 500 continues to form this descending wedge pattern. This divergence will inevitably end, and when it ends, the S&P 500 tends to align with high-yield bonds. So I'm expecting a second short squeeze to come here soon, and for that short squeeze to be used to unload even more positions for a continuation to the downside. Let's take a look at VTV divided by VUG. This is value, Vanguard value divided by Vanguard growth. So this looks at the entire stock market, all of those value names divided by all of those growth names. And we had this gorgeous double bottom with a positive divergence, lower low on the daily chart, significantly higher low on the PPO. It marked the top in the NASDAQ perfectly. The NASDAQ obviously is the growth component of the indices. If you want to look at it, you can look at it this way. The NASDAQ is growth and Dow is value. You can look at it this way, but VTV divided by VUG is the more accurate representation. And we're now seeing value beginning to outperform growth, and we'll likely see this continue into the end of the year. This is a huge double bottom, and we crossed above the 20-day moving average and the 50-day moving average, and the 20 has crossed above the 50. So I expect to see a really large rally in value relative to growth. So growth continues to see weakness and value catching a bid. Let's take a look at the copper to gold ratio. Up top is copper relative to gold. Down below is the S&P 500. I use the copper to gold ratio to assess the health of the economy. And a healthy economy, you want to see the copper to gold ratio making higher lows and higher highs. What we're now seeing is a massive, enormous bearish divergence with the copper to gold ratio making significant lower high versus the high in February, essentially meaning that the copper to gold ratio has never exited the bear market since last year, while the S&P 500 had this extended cyclical bull rally in a bear market. The copper to gold ratio never participated in that rally fully. It made a lower high versus the S&P 500. And so it looks exceptionally ugly. This chart is also extremely useful to find bottoms. If you take a look here, guys, it caught the October bottom perfectly. We had a bullish divergence, the S&P making a lower low, while the copper to gold ratio made a higher low, and that caught that beautiful bottom in October. We're now seeing the opposite, a beautiful bearish divergence, indicating that we're now beginning to enter potentially an extended downtrend in the S&P 500. That if we just simply follow seasonality, guys, just seasonality, we expect this weakness to last all the way into December. So no real gains in the market from now all the way into December, except in value and defensives like healthcare. Let's take a look at stock market breadth. We had this ascending wedge, bearish ascending wedge. As soon as it broke, the market topped exactly 1 day later. So this was a gorgeous, gorgeous tool to find market tops and bottoms. We're now seeing the histogram flattening. That's usually when we see a short-term bottom forming. Let me show you a few examples. Here it is. Histogram flattening. We had a counter trend rally after a short-term bottom. Another one here, guys. It flattened. We had a short-term bottom, then a rally. Another example is, let's take a look at this sell-off, short-term rally, a short-term bottom, and a counter trend rally. So that's in line with my current expectation, a short-term bottom that we're forming and a small counter trend rally that will be used to sell into. Let's take a look at the money time machine put to call ratio. This is my own variation of the put to call ratio indicator. This is my own version of the indicator. I have two of these, the CPC and the PC. I have to use both to corroborate the readings. You can't use one and not the other. You have to use both together. And when both corroborate each other, we get extremely powerful signals. This is an example of the signal. We had the first sell signal in the CPC 1 day before the market topped. The PC signal, again, a single day before the market topped. This is the S&P 500 down below, by the way, guys. And then we had that sell signal, the market topped the next day. We had that sell signal, the market topped the next day. And if we pair this with the breadth chart, breaking below this ascending wedge, that marked the top perfectly. That marked the stock market top exceptionally well. Okay, another sell signal is triggered when the 5-day CPC moving average crosses above the 0.95 reading. We had that happen. Let's take a look on August the 8th. Usually when that happens, we get more selling. Again, when we dip below 0.8 on the PC and we cross back above, that's when we get an extended sell signal. That actually happened. Let's take a look here. Exactly on the day the market topped. So I use both of these to find market tops and bottoms. And so far, both the PC and CPC continue to indicate more weakness in the market. Let's take a look at the fear and greed index. The greed reading is declining. Let's take a look at the overview at 66 as of Friday. I expect this greed reading to continue to decline. We could see spikes as we get that counter trend move, or several counter trend moves likely. In any medium term downtrend, we expect at least 2 counter trend moves. We had one last week that got rejected immediately on Thursday. And so we could expect another one to come in pretty soon here as those short-term bullish divergences play out. Market momentum still showing greed, stock strength. still showing extreme greed, breadth, extreme greed, put to call ratio neutral, and is rising. That's a bearish sign. Market volatility, I expect it to backtest the 50-day moving average to fill that gap at 14 that I mentioned earlier in the video. So a quick counter trend move. At the end of that counter trend move, I expect the VIX to backtest the 14 reading. That will be another shortable top that's coming in potentially as early as next week. Safe haven demand showing fear, and junk bond demand showing extreme greed. As I showed you, high yield bonds continuing to find a bid. Up top is high yield bonds divided by short-term treasuries. So this is a ratio chart that really visualizes the bond market risk appetite. When you see this ratio chart rising, it indicates that risk appetite remains positive in the bond market. And so again, when you see risk appetite remaining in the bond market, I expect that to result in counter trend rallies in the S&P 500. Let's take a look at the economic events coming up next week. Monday, we have consumer inflation expectations at 11 a.m. Eastern time. Tuesday, retail sales. And on Wednesday, building permits and FOMC minutes. Key event, market moving events on Wednesday. Thursday, we'll have the initial jobless claims and Philadelphia Fed manufacturing index, and nothing much happening on Friday except OPEX option expiration. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.